Let's start cost management now. Absorption or full costing. What is absorption costing? So generally fixed factory overheads are necessary for cost of production. See, if there is a cost, there is a production. Actually, I'm having unit finished goods. For cost of production, fixed factory overheads also we have to include it. What is fixed factory overhead? All factory expenses which are fixed in nature. For example, factories manage supervised salary, factory rent, anything fixed that is going to be absorbed to the cost of production. Unit produced. We have to transfer to the unit produced. Okay. So this product including factory cost also, factory overheads also. Right. So therefore, cost of asset that should include all the cost in the proper form. Try to include every cost which are relevant for manufacturing the product. Please add. So form, location, working condition, everything necessary to get into proper form. Please add. Necessary cost, bring it to the location. Please add. Necessary cost for making the making the product workable condition. Please add. So all the costs should be added to the proper form to make it into proper form, to bring it to the present location, to make it in the working condition. So all the costs should be added to the cost of product. So absorption costing, that's called full costing, is generally accepted in GAAP, US GAAP also. So generally accepted accounting principle, it is called GAAP. US GAAP also accepting absorption costing. Similarly, Income Tax Department of US government, that's called IRS. Internal Revenue Service means IRS. Income Tax Department of US government is called IRS. In India, we used to call income tax. In US, we used to call Internal Revenue Service. The IRS as well as US government, they recognize absorption costing for all. For any product, we're going to measure it. Now, absorption cost is also one of the technique you can use it. One of the method you can use it for computation of cost. What is just in time? Just in time. It is a Japanese concept. It is one sort of control method. Okay. See, for example, there is no stores required. There is no material acquisition. There is no material storage. So there is no storekeeper. So automatically stores to be removed. Store concept to be removed. Okay, because just in time, when the production started, how much unit we required by 10 o'clock, automatically from the supplier end to the production area, so material will be directly supplied. It is called just in time. That's it. So by the way, just in time is going to facilitate the costing. Very little inventory or no inventory at the end of the period. Very little inventory or no inventory at the end of the period because just in time. So from supplier to production process, production department, straight away materials are supplied. There is no concept of stores department. It is completely eliminated. By the same time, there is no inventory cost, there is no inventory or less inventory at the end of the period. So by the way, to compute cost of goods sold, some complications are there. To find cost of goods, some complications are there. I told you what is cost of goods sold. COG is nothing but either sale minus gross profit you can find out, or cost of goods sold is equivalent to opening stock, that is called inventory in the beginning, plus purchase of raw material, purchase minus closing stock, or any direct expenses also to be added. That's it. So opening stock plus purchases plus direct expenses minus closing stock, that is equal to cost of goods sold of the product. That's it. Either sale minus gross profit or opening stock plus purchases minus closing stock plus direct expenses. That is also you can do it. Okay. So but just in time, it is a Japanese concept. Straight away from supplier to production process, materials are delivered. It's a completely eliminating the concept of storekeeper, inventory record keeping, everything. At the end of the process, very little inventory or no inventory is there. That's called just in time. See, next concept is called backflush costing. Backflush. See, just wait for what is backflush? So backflush means, so just to wait for the product to complete it, then we arrive to the cost. So no need to calculate what is material, then production process cost, then other cost. No, just to wait. Input will be converted into output. So till then you wait. It's a backflush. So just go back and calculate the cost. Once the goods are coming out, then go back and compute the cost. So by the way, that is called backflush. Okay, just wait for the product to complete it, then go back and complete the cost. So input, process, output. Once the output coming out, then go back and compute the cost. It's called backflush. That's it. See, for example, that is also part of Japanese concept only. Okay. So here the point is, ideally inventory on hand is eliminated completely. So it is going to minimize the JIT production. So it is not necessary to use an accounting system. Okay, don't require any accounting system. Each and every stages of costing. So this is a input cost, this process cost, physical flow. So no need to maintain everything here. Here it's called backflush. Delayed costing. Allow the process to complete first. The product has to coming out, emerging out. Then go back and compute the cost. That's called post-deduction costing or JAT or delayed costing. There are a lot of terms available. They are all backflush only. Simply allow the material to complete. It is going to be converted into product. Then once a product is coming out, then go back and compute the cost. That's it. So it is a system of stockless production. Demand pull concept of JAT production. Relatively, few costing accounting transactions are recorded. That's it. So what is trigger point? So something required to trigger, correct? No. The trigger means suppose recording should be done in every detail of manufacturing. Normally, in the manufacturing process, every detail to be recorded properly. But here, instead of recording every detail of manufacturing process recording, simply there are some trigger points going to happen, or triggering events are going to happen. Once events are triggered, then you record it. For example, raw materials are acquired. Generally, we'll record transaction. Then it is going to be put into manufacturing process. Then automatically triggering events started. So any purchase of material or completion of manufacturing is called trigger points or pay points. So either completion of manufacturing or purchase of material or point of sale, accounting entry generally used to be done. What has happened? Purchase of material, entry. Manufacturing completed, entry. Similarly, say point of sale, POS, entry. Sale has been happening, entry. That's it. So there are different methods or versions of backflush costing available. So something need to be triggered. That's it. There are different trigger points or combination of points will be taken into account. So purchase of material, one trigger point. Completion of manufacturing, one trigger point. Point of sale, one trigger point. So trigger points are happening, that is in it be recorded. That's it. So two JST cost tracking. Two JAT cost tracking. So two JAT system is an operation or zero or very low inventories or faster throughput. That's it. So JST cost tracking. Very true JAT system is an operation. So what is true JAT cost tracking? Just in time. Only one trigger point. That is completion of manufacturing is recognized. That's it. Just in time means, so straight away supplier ended to manufacturing process, materials are sent. So manufacturing completed, then the triggering point started. Then make an entry. That's it. So then now the entries are made to finished goods. Over, yes, converted. Payables created, supplier we have to make a payment. Payable created, yes, entries to be made. Conversion cost applied and accounts manufacturing completed. That's it. Now applied means estimation. What is generally conversion cost? Conversion cost means excluding material, which means direct labor plus direct expenses plus all factory overheads. Raw material excluded from conversion cost. So direct labor, direct expenses, factory overheads is equal conversion cost. So for entries to be made are the trigger points only. Just in process, just in time. What is just in time? Straight away supplier ended to, so production area, material sent. So automatically there is a trigger points going to happen. So finished goods, trigger point. The supplier we have to make a payment. Payables created, trigger point. So conversion cost estimation to be applied. What is actual conversion cost? What is estimation conversion cost? Over applied or under applied? We have to check it out. So then overhead cost to be applied. Then finally the cost of transfer to cost of goods sold. COGS you have to transfer. Here no inventory cost to be kept for raw material or WAP. No inventories are kept in hand because just in time, no. So whenever how much is required? 10 o'clock the production process is going to be started. 9:30 the materials are reaching the production area. That's it. At the end of the process, once the manufacturing process is completed, so less inventory in stock in hand. That's it. So no need to record everything. So material comes in, material goes out, WAP, no. Only finished goods to be triggering point. That's it. So for entries to be done, especially in just in time, finished goods entry, payable entry, conversion cost entry, you have to do it. That's it. Similarly, everything will be transferred to cost of goods sold, COGS. So the cost of goods sold plus selling overheads is equal to cost of sale plus profit is equal to sale. That's it. So everything will be added to cost of goods sold. So cost of goods sold plus selling overheads, selling and distribution overheads. Please add, you'll be getting cost of sale. So plus profit to be added, that is equivalent to sale. That's it. It's called true. Next to our concept is called throughput costing. What is generally throughput costing? So generally materials are introduced input stages. Now the production started, process. So materials are completed, coming out. The products are coming out, emerging out. It's called finished goods, output. So once it's happening, outputs are coming out, then go back and calculate how much cost has been involved. That's called throughput. So entire process, the input, output, process, what are the cost element involved? It's called throughput. Looking back, the concept is called throughput. So in just-in-time concept, no inventory tracking record required, no inventory on hand, less inventory stock. That's it. So once the trigger points are started, then make an entry. The trigger points in JET, finished goods, accounts payable, conversion coins, conversion cost. So they are all trigger points. Then applied accounts will be taken. Then what is the actual cost involved? What is applied element? Please compare. Either it may be over applied or under applied, or overestimation or under estimation, or over absorption or under absorption, or overvaluation, undervaluation. Please check it. Sometimes there are two trigger points available. Okay. So the two trigger points are, for example, either purchase of material, completion of product, two trigger points, make entry, or purchase of material, point of sale, the other 2 points. Either these 2 points or that 2 points, make an entry. Purchase of material, completion of product, trigger point, make entry. Purchase of material, point of sale, make entry. That's it. So here none of the versions of WIP, here there is no WIP is involved. There is no WIP. The account called raw in process, RAP. Raw material and in process. So generally raw material work in progress are the two stages, correct? No, once they call RIP, raw in process. Okay, they call combinedly called raw in process. That's raw, now the process. Then raw in process, then finished goods. There is no separate concept of work in progress. So two trigger points: purchase the material, completion products. 2 points. The other 2 points: purchase the material, point of sale. That's it. Suppose any one of the two trigger points method, you can make an entry for this. That's it. Okay, right. So materials that are either in the process or material in the warehouse. The accounting called inventory is used in other two trigger points also. So when there are two versions of trigger points, two trigger points model. So one trigger point. So two point, one trigger point, purchase of material, completion of product. The other trigger point, purchase of material, point of sale. Either one of the trigger, either one of the method you can apply. So then make an entry. That's it. So either accounts for all materials that are either in the warehouse or unsold, make an entry. Okay, right. So what is the how much materials are available in the warehouse? Please make an entry. How much unsold finished goods are available? So finished goods ready, but they are unsold. What are the costs involved? Please make an entry. Let's see one example. The following example for ABC company is used to illustrate the 3 different versions of backflash costing. What is backflash? Just wait till the end, go back and compute the cost. Backflash. Throughput, backflash, almost they are more or less same only. Backflash. Just wait for the process to complete. Once it is completed, go back and compute the cost. Backflash. Looking back. That's it. Standard cost. So the standard cost department, they put the material. This is the standard cost fixed for material $10. Conversion cost $6. So total cost 16. So conversion cost is nothing but direct labor plus direct expenses plus factory overheads. All factory overheads. They are called conversion cost. That's $6. What is total cost of product? It's going to be $16. So production sales and cost data for the month of April given. What is material purchases? Actual material purchases. $105,000. Actual conversion cost incurred $62,000. Actual units produced. This is standard. Company fixed the standard. This is actual. Actual unit produced 10,000 units produced. Actual units sold. 9,000 units. That's it. Actual unit produced 10,000 units. Actual units sold 9,000 units. That's it. Now, question 1, entries to be done. Trigger point of completion, purchase of material. Point of completion, purchase of material. That's it. So materials are placed into production. That event is ignored. No entry. So conversion cost incurred, entries to be done. So one trigger point even. So conversion cost incurred, entries to be show actual cost incurred. That's it. So conversion cost given, yes. What is estimated conversion cost? 6 rupees. $6. What is conversion cost incurred actually? 62,000. That's it. So conversion cost is equal to one trigger point. So actual cost incurred, can you record it? Yes, we can record it. So conversion cost account data, Conversion cost account data, that is actual. That is actual. Conversion cost account data, 62,000 to payroll account or accounts payable account. That's it. The conversion cost account data to payroll account. The conversion cost account data to labor also involved. No. Okay. Various accounts to please transfer. Please transfer. Conversion cost means it is a combination of, told you, direct labor, direct expenses, and factory overheads. All three. Please transfer the conversion cost actually incurred to various control accounts, payroll account, accounts payable account. That is 60,000. So conversion cost account data. So conversion cost account data to various control accounts. So to various control accounts. That's it. It is going to be 62,000. That's it. Now 10,000 units completed. Trigger point. Right. Now how many units completed here? 10,000 units completed. That's it. Material $10 per unit. Conversion 6. Estimation. Standard means estimation. This is 10,000 units actual cost. 10,000 units actual cost. 10,000 units actual conversion cost. This is estimation cost material per unit. Conversion estimation cost per unit. That's it. So entry. So 10,000 is completed. Trigger point to be done. I told you finished goods trigger point. Conversion cost trigger point. So 10,000 finished goods entry to be done. 10,000 is completed. 16 rupees per estimation cost per unit. Can you make an entry? Yes. So entry for this. So finished goods control account data. So that is equivalent to 10,000 unit into $16 per unit estimation. $160,000. So to accounts payable, that is raw material purchased, 10,000 into 10, 100,000 to conversion cost applied estimation. So 10,000 into 6. So 60,000. So trigger point for estimation cost coming to account. Actual material cost 105,000. Actual conversion cost 60,000. But I make entry for standard costing method. Standard cost is trigger point 10,000 into 10, 10,000 into 6. I make an entry. That's it. That's a trigger point. The conversion cost to control account, finished goods to accounts payable, conversion cost. That's it. So this is actuals. This is estimations. Applied. Estimations are applied. This is entry for applied. Finished goods account data to accounts payable to conversion cost. That's it. 10,000 to 16. Please transfer to finished goods. 10,000 to 10. Please transfer accounts payable. 10,000 to 6. Please transfer to cost of conversion cost applied. So this is actual. This is applied. Actual applied. Actual conversion cost. Applied conversion cost. So under applied only. Please check it out. 60,000 less than 62,000. This is estimation or applied. This is going to be actual. So here estimation less than actual. It is called under applied. Under applied by $2,000. So we estimated the conversion cost supposed to be $60,000, but actually it is incurred as 62,000. 60,000. It is under applied. Under applied means loss for us. Under applied means loss for us. Loss. Under applied means loss for us. So 9,000 units sold. We have to make entry for this. So cost of goods sold account data that is equal to 9,000 units into 16. That is equal to 144,000. That is will be transferred to 9,000 to 16 to finished goods. The cost of goods sold account data to finished goods 144,000. That's it. Now events to be recorded. COGS events to be recorded. Finished goods events to be recorded. Actual cost events to be recorded. Trigger point actual cost entry normally to be done. Trigger point finished goods entry. Trigger point COGS entry. Finished goods trigger point. The other trigger point is going to be cost of goods sold. That's it. That's it. So $2,000 is going to be under applied conversion cost. It is directly adjusted to COGS. So it's a loss for us. Please transfer to COGS. Please transfer to COGS. Please transfer to COGS. That's it. Similarly, accounts applied $100,000. But actual material 105,000. Actual material 105,000. But applied 100,000. Actual material cost 105,000. Applied material cost 100,000. Again, here also, no WEP, material inventory cost. Materials are not yet in finished goods. So $5,000 in the not inventory. Applied only in zero or minimum inventory cost. See here, the trigger point is there are two trigger points model applied. So for raw material cost, I'm not taking into account. So anyway, if you're going to take raw material cost, what is the actual? What is estimation? What is applied? Applied raw material. It's not a trigger point for me. It's applied because for me it is going to be conversion cost and COGS is going to be trigger point. So applied actual for raw material point of view. Raw material applied, raw material actual. Raw material applied, it is going to be 100,000. Actual raw material is going to be 105,000. But there is a 5,000. Okay, that is also under applied. But it is not trigger point for me because I am taking a trigger point. So conversion cost, and cost of goods sold. Cost of goods sold is a trigger point for me. That's it. Therefore, no WP, no material inventory accounts are required. Almost minimum inventory. That's it. Okay, right. So it is a fast throughput accounting, which means you have to take into account conversion cost and COGS. Nothing will be taken into account. That's it. So raw material don't take into account. Conversion cost and COGS are two trigger points. That only to be taken into account. That's it. So if there any conversion cost under applied, please charge to COGS. Please transfer to COGS. Please debit to COGS. So different traditional tracking methods available. There are two trigger points. Purchase of material and sale of products. Two trigger points. Purchase of material and sale of product. Two trigger points. Version 2 model. So here trigger point 1. Whenever the materials are purchased and products are sold, the entry to be done. So inventory material, that's it. Actual material cost, yes, 105,000. That's it. So material inventory account data purchased to accounts payable. Supplier we have to make a payment. That is equal to 105,000. So already this is actual material inventory. Actual inventory material cost. That's it. So material inventory account data to accounts payable account. That's it. So purchase of material and sale of product. So these are the different methods of tracking available. Here the tracking material is they're going to use it. Purchase of material and sale of products. Middle purchase trigger point 1. Please make an entry. The materials are placed into production. That's it. Please make an entry. Events ignored, no entry. Generally WEP, nobody will do an entry for this. No entry for WEP. No WEP entry. That's it. Conversion cost incurred, even second is it. Same entry to be done. I told you already, entry to be done. That's it. So conversion cost account data to accounts payable or payroll account to be entered. That's it. So 10,000 units completed, events ignored, no entry. 9,000 units sold, trigger point. Because the trigger point here I mentioned purchase of material, trigger point 1. P1, trigger point 1. This is happening, make an entry. This is happening, make an entry. Purchase of material, trigger point 1, make an entry. Sale of product, trigger point 2, make an entry. That's it. So middle purchased, middle control data to accounts payable account, 105,000. WAP, ignore it. Production cost, ignore it. Sale, please make an entry. So completed, ignore it. Sold, that's it. So one theory of trigger point says purchase of material and sold. 9,000 units sold, right? What is cost of goods sold account? The cost of goods sold account data 9,000 units into 16 estimation cost. 9,000 units sold into 16, 144,000. So cost of goods sold consists of material 10, conversion case 6, adjustment. So COGS account data to material inventory to conversion cost. So 9,000 to 10, 90,000 estimate material inventory, 9,000 to 6, 55,000 applied conversion cost. Material inventory applied. COGS also applied. Everything is applied. That's it. Estimation. So COGS account data to middle control to conversion cost. That's it. Conversion cost is including direct labor, direct expenses, and all factory overheads. That is called 6 per unit. 6 per unit. That's it. That's it. Here also 5,000 material. I told you. See the applied actual sale. Actual sale. Applied raw material, actual raw material. Actual raw material is going to be 105,000. Apply is going to be 100,000. 100,000. So 5,000 is the difference. 5,000 difference. Okay, right. So 5,000 material inventory, balance related to material not used in production. Not used production. Because 1,000 units are completed but not sold. No. So 10,000 units you produced. 9,000 only sold. So balance 1,000 units is stock. 10,000 units produced. In the example I given, 10,000 units produced. 9,000 only sold. 1,000 stock. 1,000 stock. So 1,000 units. Okay, 5,000 material inventory balance relates to material not used. Not used. So 1,000 into 5. 1,000 to 5. That is equal to 5,000, which is not sold. So that 5,000 difference we can transfer here. That's it. So no conversion cost related to 1,000 is completed because they're not sold. No, they're not sold. No. So point of sale we make an entry. There's no point of sale for. There is no point of sale. 1,000 unsold. No point of sale. Upon no entry. No entry. No conversion cost to be attached. So no point of sale. No point of sale. No conversion cost. Only stock in hand. Stock in hand. That's it. So generally under applied conversion cost usually written off to COGS. Under applied conversion cost usually written off to COGS. That's it. Discourage profit distortions through manipulating inventory production levels. So discourage profit distortions through manipulating inventory production levels. Please make an entry. That's it. So discourage profit distortion to manipulating inventory production levels. Please transfer. So here the main point is they are going to discourage it. Any profit distortions. Okay. In this method, profit distortions. Okay, so totally discouraged because we are taking only conversion cost. That is only going to be applied for COGS and material inventory will be taken into account. Here profit we are not coming so far. Okay. So therefore discourage profit distortions because we just stopped up to COGS. Correct? No, there is no profit scenario here. Okay, right. So under applied conversion cost will be charged to COGS. Trigger point here, purchase of material under COGS. That's it. Point of sale. Next, two trigger point models. Purchase of material and completion of product. Purchase of material, cost of goods sold. One trigger. Purchase of material, completion of product. Other trigger point. Here the trigger point one, inventory process, run in process. Okay. Inventory run in process RAP. 105,000 estimation to accounts payable. That's it. Trigger point one. Please make an entry. So whenever the trigger points are happening, please make an entry. That is also especially for estimation only you have to do it. So especially raw material you have to do it for actuals. Estimation to be transferred to COGS. Estimation to be transferred to production cost of COGS as the case may be. But actuals we have to transfer to raw material cost to accounts payable. How much you have to due to the payment to supplier? 105,000. Remaining things are as it is. Conversion cost remaining, even the recognized same entry, we have to do it. That's it. Suppose 10,000 is completed. Trigger point 2. Can you make an entry? That's it. So 10,000 units into already we did 10,000 into 16. Finished goods unit. To raw in process, run in process 10,000 into 10. To inventory 1 lakh. The conversion cost applied 10,000 60,000. That's it. So estimation. Finished goods account data to inventory raw in process to conversion cost. So for this trigger point 1. Next 9,000 units sold. COGS account data to finished goods. So 9,000 into 16. To finished goods 9,000 into 16. That's it. So cost of goods sold account data to finished goods account. So 9,016 transferred to COGS. 9,016 transferred to COGS. Finished goods to be cancelled. COGS debited, finished goods credited. That's it. COGS transferred, finished goods be cancelled. That's it. Now finished goods become COGS. As long as they are in the stock, finished goods. Once they are sold, stock to be cancelled. That's it. So COGS to finished goods. As long as they are in the godown, finished goods. Once the finished goods are taken out and sold, CO just to finished goods. That's it. So 9,000 sold to finished goods, CO just to finished goods. 10,000 units produced. So 10,016 to inventory, 10,000 retained to conversion, 10,006. Here also no WAP account, no WAP account. Balance of 5,000 in joint process accounts, that is in the warehouse only. Under applied conversion cost, no. So that will be adjusted to COGS, or if possible, carry forward. Okay. But generally, they are not supposed to be prorated. I told you. And the inventory levels are very low, turnover is very fast. Don't under applied conversion cost, don't allot on the pro rata basis between COGS and finished goods. So when the inventory levels are very low, when the inventories are faster moving, so under applied conversion cost, don't charge pro rata basis between COGS and finished goods. Please carry forward. Suppose inventory levels are very high, then pro rata. Inventory turnover is very slow, pro rata. When the inventory levels are very low and fast, don't pro rata between the under applied conversion cost between COGS and finished goods. Please transfer straight away to COGS account or carry forward to next season. This idea. Let's see. See, generally the CMA exam required. Generally, manufacturing paradigm is the ultimate aim of cost management, cost governance, cost management, cost control, reduce the cost and improve the manufacturing efficiency. That is the ultimate thing. Our CMA exam required from your side, sir, how to reduce cost, how to improve the efficiency of the manufacturing product, how to reduce the wastage. Okay, enhance the effectiveness, efficiency in the production process. Cost to be reduced, efficiency to be increased. That is the ultimate aim. They shifted. So a lot of questions are coming out of cost reduction and efficiency model only. Sir. So just in time, JIT I told you, right? JIT production system. Okay. So demand pull model. Based on the demand only, the production will be started. The JIT requires detailed system of integrating sequential operation of the process. What is the accurate sales forecast? How much effective finished goods are happening? Please make production scheduling. The product should be designed, use standardized parts. This is the manufacturing time per unit. This is per unit input cost. Please standardize and actuals. Compare. Find out the difference. Variation. Observe. Either it may be adverse or maybe favorable. Our JIT inventory system is one which is company develops a group of reliable local vendors who can supply inventory with a minimum lead time. That's it. Automatically call the local vendor so that time to reach your factory will be minimized. Minimum lead time. Once you ordered it, within 6 hours you can get it. Because the vendor is the next street only. Because the vendor will be in another 3 kilometers range only. That's it. If you ordered it 3 hours, the delivery will be done. Why do you need any storekeeping? So minimal lead time. That's it. Okay. So automatically JIT inventory is very company going to develop it when the vendor is very local and the lead time to reach the order. Once the order has been placed, the lead time to recover to reach the material in your side, it's going to be minimum time, maybe 5 hours, 7 hours, or within a day. That's it. So, but JIT is going to reduce the lead time. Just in time. Local vendors available. Allow them, contact them. If there in case any emergency, call them. Immediately it will be delivered. That's it. Next important thing in cost is called quality control. See, if the input is quality, output is okay. If the input is critical, output is weak. That's it. Everything depends on input material, quality control. So little or no inventory kept in on. So production is interpreted if they do not arrive as needed or defective. See, on time, if not arrived, your production interrupted, stopped. The materials are defective, your production interrupted. So quality control is very, very critical. You try to maintain a good relationship with your vendor. Please ask them, sir, I need pakka material, high quality material with frequent delivery. So quality control procedures to be take place. That's it. Suppose quality control procedures are not in place, your entire process will be breakdown. The production stopped because you have defective material reached, because on time not reached. Your production scheduled affected. Breakdown is going to be happening. Therefore, quality control you have to focus on. Next theory is called Kanban theory. Kanban. The Kanban. So they are all Japanese term only. The Kanban is a technology term used in Japan. Just in time production. Just in time production. That's it. So the basic principle of just in time production, the basic principle of just in time production is not to produce anything until the next stage of production process is ready to work on it. So if there is a demand, pull it. Otherwise, don't go for the production. There is a demand, pull it. That's it. That's the demand. If there is a demand, pull it and allow the things to produce. That's it. So really the production process required, then demand the product, pull it. The procedure generally originated in Japan. Kanban, Kaizen, just in time, they are all Japanese terms only. That's it. Accuracy means quality control. So QC circle, Japanese term. How are you going to control 10,000 workers in a company? It's a tedious job. In Japan, what they're doing, the 10,000 workers in a company, they will divide into quality circles, QC. For example, 10 for example. So for 10 members, one leader will be allotted. So one QC created. So 10,000 workers are available now. Apo they'll be divided into 1,000 into 10. Each group 10 members, 10 workers. 1,000 into 10. Controlling the quality circle, controlling the working environment. You cannot control 10,000 people at a time, but you can control 1,000 quality circles. Each quality circle represents 10 workers. So each quality circle have a head. So controlling the head, controlling the quality circle. By the way, quality will be achieved. That's it. That's called QC. Quality control also one of the important terms in Japan. Japanese term only. That's it. The Kanban technique. So if there is a till the next stage of production required, so don't demand it. That's it. The Kanban is a communication device, which may be a card, which may be a sign, which may be a production bin. I have. Okay. When work is completed in one area, the card or sign or empty bin written to the proceeding work area, which means sorry, empty bin, I need material. So material are used. Again, empty bin sent. Again, materials are coming in. So used. Again, empty bin sent. Just like this. So signal. Whenever card comes in, material requirement. Whenever sign comes in, material requirement. Whenever empty bins coming in, the signal material. So we need products. We need products. That's it. So the demand only triggers the production. The previous station. That's why in all car manufacturing company, after taking the car order from the dealer, then only the production will be started. Unnecessarily, they won't produce it. So how long will it take to deliver the cars? 1 month. Once the order has been taken, order will be given to the manufacturing department. So manufacturing department, they will start production. But demand only triggers the production of the previous station. It is called demand pull model. Demand pull model. Ultimate demand is a customer's order or anticipated order. That's it. Can you estimate orders? Yes. Can the customers order? Yes. Demand created? Yes. Then the production should be started. Unless until demand started, production cannot be initiated. That's it. It's called Kanban technique. Kanban technique. So production initiated, then demand started. Demand started, sign will be given, or card will be given, or empty will be given. So materials are coming in, produced, empty bin sent, produced, empty bin sent. So demand started, production initiated. That's it. So Kanban technique. Kanban technique. Let's see. So the characteristics and objectives. Just-in-time production has the following characteristics and objectives. JIT quality. Smooth production flow. Ultimately possible. Yes. Uninterrupted flow of materials needed from supplier. Number one. So once you have got the assurance from the vendor, automatically material will be supplied to production area. So production will not be stopped. Finally, the process initiated. Finally, customers' goods will be delivered without any fluctuations. Raw materials are arriving on time when needed. Each sub-assembly. Automatic production process functions smoothly. Whenever any sub-assembly required material, just in time they will be arrived, so you can start the production process. So automatically, first characteristic is smooth production flow. Number two, pull method of production, which means each and every stages of production, pull method is used. Demand started, then pull it. Demand started, pull it. Okay, just give a sign, pull it. Just give a sign, pull it. So each and every stages of manufacturing process, the pull production method will be applied. That's it. Demand started, pull it. Demand started, pull it. Small lot sizes. So purchasing materials are producing purchase materials and producing sub-assemblies are always small lot sizes. So inventory build up and associated cost completely eliminated. Small lot. So don't order too much. Order small quantity, small numbers. By the way, inventory buildup reduced or eliminated. And other costs related to inventory buildup completely eliminated. Don't build the inventory. Unnecessarily don't invest in inventories. That's the just-in-time concept arrived. So any material or any produce sub-assembly, always small lot sizes required. That's it. So today, how much you're going to produce? This is today's requirement. Tomorrow, how much you're going to produce? That is tomorrow's requirement. That's it. Don't build the inventory. Don't invest too much in inventory. Automatic inventory build-up cost, other cost will be eliminated. And reduce the setup time. Production setup time is necessitated by production in small lot sizes. So setup time reduction is necessitated. Automatically production in small orders. That's it. See, once small lot sizes coming in, setup time also reduces. Setup time cost also reduces. Because small lot sizes are going to be produced, above setup time also reduced. Lot sizes are increased, more setup time. Lot size are decreased, less setup time. That's it. So these are the categories of just-in-time JIT. Plus high quality standards. So just-in-time gives a high quality standard for each and every product. So direct material, high quality standard. Finished goods, high quality standard. So shutdown, we can avoid it. Waiting time, we can avoid it. Because of just-in-time concept, shutdowns are eliminated. Production process initiated. Continuous supply of material, continuous supply of production, continuous production is going on. So waiting time reduced, shutdown reduced. Preventive routine equipment maintenance. See, once the shutdown is routine preventive maintenance works, avoids downtime also. So the machine will work forever because we'll go and check. So preventive maintenance, we can do it. We can do it. So by the way, any malfunctioning and associated waiting time cost, result delay, completely we can eliminate. So preventive routine equipment maintenance allows a preventive cost, preventive maintenance cost. Once you're incurring any preventive maintenance cost, almost your waiting time cost will be eliminated. Shutdown cost will be eliminated. That's it. Complete every month once or every week once, please maintain your equipment properly. Lubricate them. Then lubricate them. Then overhauling them. That's it. So by the way, so automatically the machine will continue forever. So any shutdown, other related waiting cost, the other things will be easily eliminated. JIT will promote effective employee teamwork because ultimately we have to improve the quality of the product. So production efficiency and reduce the cost. So employee teamwork will be effectively increased. Next, number 4, versatile workers and equipment. In order to produce a variety of products, they needed to avoid bottlenecks. In every product, there is a bottlenecks. What is a bottleneck? So generally, there is a term in corporate circles. What is bottleneck? Bottleneck is always in the neck of the bottle. See, when the head of the department troubles you, the entire company will be in trouble. Where is the bottleneck? Neck of the bottle. That's called chief executive. That's it. So here, that's a joke I'm telling. Okay, fine. Here, the bottleneck means what prevents you. What prevents you? That's called bottleneck. So in order to produce variety of products, you need to avoid all the bottlenecks associated with the product and other resultant high cost. Please avoid it. Any bottlenecks, please avoid it. So the workers and equipment must be the versatile, multiple personalities. The equipment can be used for multiple purposes, multiple times. The worker can be used for any number of times, effectively, efficiently. That's it. He's a versatile worker. Complete knowledge of the product, he knows. So equipment, multiple times you can use it. Because once we try to avoid the bottlenecks and other costs, automatically workers and equipment must be versatile nature. That's it. The worker knows exactly how to use the equipment. So the equipment and workers are coming together. So more effective product will be coming out. So these are the quality standards of JIT. So next one, work manufacturing cells. In JIT production system, work is often broken down into set of tasks. So don't do the task completely. Break down the task. Set of tasks. Task 1, task 2, task 3, task 3. Break the task. Give the task. So automatically, task has been given. Okay, break down the task into task. Okay, so 5 hours work. They were into 5 into 1 hour. 1 hour task, 1 hour task, 1 hour task. So each cell, so they can better perform the task properly. Once you're focusing on the particular hour automatically, cumulatively, more effectively you are doing. That's it. So GST system always give the work divided into task. Each task you focus on it. Ultimately, the end product will be coming out in good condition. That's it. Effectively coming out. What is the just-in-time advantages? The just-in-time is going to savings in the form of carrying cost, inventory holding cost, working capital. Everything will be reduced. Carrying cost, supporting inventory cost, storage cost, inventory taxes, insurance, security cost, everything will be minimized, reduces. So most of these shifted to supplier only under JAT. See, once you have a storekeeper, it is your cost. But just in time arrival, everything will be pushed back to supplier only. What is I need by 9:30? 9:30, that's it. I don't have any storekeeping department. So because of just in time, so these are the advantages for me. Inventory carrying eliminated, storage eliminated, inventory taxes eliminated, insurance for the product comes in eliminated, security cost eliminated. It is just going back shifted to supplier only. That's it. I have free space, more production I can start. I have more free space available, less visible advantage. So JAT system requires better overall inventory and production management, which is going to promote total quality control of the product. So JLT ultimately produce overall inventory management cost will be controlled, better quality control of the product will be emerging out. So inventory hiding problems such as quality problems, bottlenecks, any coordination problems related to inventory, obsolescence, new things comes now, old things will be going out, obsolescence, shrinkage, supply unreliability, everything will be hidden because of JAT. Because of JAT, these things are hidden. They are not coming out. It is going to hide these kind of problems. Quality problems, bottlenecks, coordination problems, obsolescence of the product, shrinkage of the product, supply unreliability, completely eliminated, completely hidden. That's it. It's going to hide these problems. So just in time, once implemented, these problems can be easily solved. So rather than worked around with the inventory buffer. So inventory buffer means so buffering. So generally today I need 100 kg stock, extra 20 kg stock I can hold it, buffer. Can you hold some extra stock buffer? Because anticipated demand will be sometimes will be higher. Unexpected demand will be happening. Extra material required to meet extra demand. That's called buffer. Normally in product festival season, all the suppliers, all the shopkeepers, they have extra stock. That's called buffer stock. They may not know how much rush is going to come in. Okay, so extra stock they can keep it. That's called buffer stock. So solving these problems automatically is going to improve the productivity of the company. That's it. Automatically employees, the equipment, productivity, efficiency, effectiveness will be automatically increased. These are advantages of JAT. What is the disadvantage of JAT? See, there are pros and there are cons also. There are plus and there are minus also. What is disadvantage JAT? So it is necessary to receive input with a minimum lead time. The vendor's reliability becomes very important. See, vendor reliable na JAT advantages. Vendor non-reliable na JAT failed model. Because 9:30 the production required. 9:30 the production, we have to receive the material with the supplier. We're not receiving the material by 9:30, your entire production process will be disrupted. Enter reliability only on the vendor point of view, supplier point of view. That's it. Suppose if you don't have any alternative supply sources, automatically you are locked on the day. That's it. The production stopped. The vendor, it cheated you, collapsed. You collapsed totally. So no alternative supply sources now, your production stopped on the day. That's it. Your material and freight cost, multiple small orders may go up. Immediately 9:30 material not comes in. What happened? You'll call other supplier. You'll be in the tension only. Material, freight cost that day will go up. The supply network must be continuously monitored because variables are usually less controllable. System only will take care, but here the variable cost will be out of stock, out of hand. That's it. Everything will increase. Suddenly will increase. Customer dissatisfaction, delayed possibility, downtime. On time we are not handed over to the customer. So brand loyalty of the company will be deteriorated. Ultimately, downstream users, they affected, distributed, affected. You cannot measure how much effect you're going to give it to them. You cannot measure. That's it. Therefore, these are the minus points of JAT. But next one, MRP. Material Resource Planning, MRP. What is MRP? MRP means resource planning or material requisition planning. See, everything has been computerized nowadays. Correct? Now, ERP tools are available. MRP is a system, material resource planning, material requirement planning. It is the use of company information to scheduling. The system itself will make scheduling everything. It will take order inventory of raw material, other components. MRP will take care. MRP refers to use of computer information system to scheduling and ordering and other components which are used for the production. Used for the production, manufacturing. That's it. A sales forecast, a specific customer order or complete product unit, specified given requirement date. Everything will feed in the MRP system. That's it. The system will generate bill of material. You can use it. It can generate master production schedule. It can generate, identify the type of material we're going to use it, type of components we're going to be needed, quantity of components needed, determines the amount and timing of orders to be placed. So determines the amount of order and timing of order to be placed for needed components. That's it. System, MRP system will take care of everything. The production schedule, timing of orders, everything it will take care. So the orders may be placed through EDI, return data interchange, or traditional ordering system. But in recent years, after the introduction of MRP has evolved, material planning is involved, both material and financing, cash requirements, inventory purchases, MRP will take care. That MRP computer system will take care. That's it. Using material resource planning system, MRP system, increase the profitability, improving the inventory management. So inventory management is going to be improvised. It is going to reduce the investment unneeded. It is going to potentially obsolete inventory will be removed. That's it. So MRP is going to increase the profitability. MRP going to improve the inventory management system. MRP going to reduce the investment unneeded. Unnecessarily, don't invest in inventory. Please remove it. MRP will guide you. Any stock obsolete, no longer required, redundant, we can able to avoid it. We can able to avoid it. Any obsolete inventory, stock investment, redundant, no longer usable, can be removed. That's it. So don't invest too much in stock, unnecessary. Don't invest too much. Working capital has been locked. That's it. It helping the manager by using MRP, these kind of things will be removed. It is going to helping the manager identify the situation. Okay, initially it is appropriate to incur additional shipping cost to receive material whenever the material needed. Then identify the situation, then order it, procure the material, then production should be started. MRP will take care of everything. It is used computer system. Okay, MRP is a kind of system is going to be used. So totally computerized. That's it. Whenever needed, please make an order, go for the production schedule. That's it. MRP will take care. Material resource planning will take care. Sometimes it cheapest one outsourcing. See, I am very good and one thing, the one which is not good, I'll outsource it. That's it. By the way, I can able to say, I'm very good at mechanical work, but system I don't know. Mechanical things I can take care because I'm expert in that. System oriented I won't do. I leave the job to outsourcing because it's going to save my time also. It is going to save my cost also. That's it. I'm a specialist in one area. I focus on it. When you're not specialist in other area, outsource it. That's the easiest thing. That's a lot of jobs are outsourcing nowadays. So nowadays manufacturers throughout the world, including US also, outsourcing is job. A lot of US jobs coming to India because outsourcing. Because China and India low labor market, low cost labor market. Materials are cheap, labors are cheap. So that's why they're outsourcing to India, outsourcing to China. So outsourcing going to reduce the cost, improve the flexibility, to modify the strategies, and it's going to operating plans also changing circumstances. Outsourcing is the better opportunity nowadays because it is going to reduce the all manufacturing cost. Outsourcing to India, outsourcing to China. Okay, by the way, the cost will be reduced. Right? No need to focus on the unknown area to you. That's it. This is a process of subcontracting the work to third party for exchange of payment. This is a job you have to do it. Outsourcing to you and make a payment once the job is completed. That's it. The one concern, there are a lot of jobs are coming to outside the country also, offshore locations. Nowadays, a lot of developing countries, Philippines, India, China, Bangladesh. So a lot of things are available. So Bangladesh also one of the important textile market nowadays, the global textile. All the textile markets are moving to Bangladesh nowadays. From Sri Lanka, the textile market moving to Bangladesh. From Tripur, India, the materials are moving to Bangladesh. So Bangladesh is one of the hub for international textile market. So the fastest growing economy, Bangladesh also nowadays. So all the from China, because of Sri Lankan problem, economic problem. So Sri Lankans know the textile market moving to Bangladesh nowadays. So there are a lot of companies throughout the world, even for research and development, R&D, they transfer to India and China because a lot of engineers available in India and China, lower cost, lower labor cost. So they're outsourcing to India and China. Some of the reasons for outsourcing, including cost saving. Once it has been outsourced to India and China, it is going to lower the cost. So because cost is saving, unnecessarily I can spend time for the activities which is not relevant for me. That's it. I'm not specialist in that. I can reduce the cost. I can focus on my core business. This is my core business. This is my focus area. I'll focus more on it. I'll put more focus on it. That's it. The company may outsource the service, IT, so that they can concentrate on the develop the core center business. So the core business they can able to concentrate on it. That's it. I'm a specialist in this area. Please focus on it. Make money out of it. Specialize. Improve the productivity. Effectively improve it. That's it. Just to show the effectiveness. That's it. So the company can able to oversee the service in with a specialist. The one which you are not specialist in that area, please outsource it. That is not a relevant job for it. Please outsource it. Similarly, outsourcing going to improve the quality. I'm not a specialist in the product. I'm outsourcing it. I'm just handed to the specialist. He can do the work. He can give it back to me. That's it. Similarly, improve the quality. Outsourcing is going to improve the quality. Capacity management. The risk is in providing excess capacity. Is going to bond with service supplier. That's it. Any excess capacity, outsourcing person will take care. Correct? No, it is not my job. My job. So capacity management services and other things will be easily improvised. That's it. Excess capacity risk will be shifted. It is your job to produce, not my job, because I outsource it. That's it. Then other contemporary means now, relevant for this year, relevant for this century, for this decade, contemporary now. Know what is relevant. Now what relevant. So a lot of contemporary productivity concepts are emerging out nowadays, relevant for this current economic situation. Latest technology we're using, technology driven. So blockchain, we are using in everywhere. Nowadays, going to be in another 10 years, blockchain is going to be there. Cryptocurrency, blockchain, IoT, SaaS, software service, internet things going to be happening. So because is a productivity also going to be improvised. That's it. Right. So automatically, so whenever using technology, your cost will be increased, but effectiveness will be increased. So using technology will improve the cost, increase the cost, 100%, no doubt at all. But effectively, you can deliver it. That's it. It is going to increase acceptance also, adoption also. Ultimately, your cost will be falling down. The system quality improves. That's it. The quality of system will be improvised. That's it. There are a lot of contemporary productivity concepts available using the technology. Really, you can use IoT, blockchain technology, costlier, but at the same time, more effectiveness will be improvised. Okay, right. More governance will be established. More governance. Nowadays, you're using everything to robotics, robots, automation. Everything is automation. In future also, routine tasks will be automated. Only skilled people will be recruited. If you're unskilled, robot will take care. No job for you. That's what you try to always increase your skill. Because routine nature will be automated in future. Automated. Robots will take care. So computer-aided manufacturing design, CAM, every manufacturing process is controlled by the computer. Already program has been given. It will take care. Little human invention. So earlier 100 people involved. If now 2 people required, for 90 people thrown out of the market. Everything we can use mechanical machines will take care. Repetitive tasks will be automated. Debit credit entry posting automated. So potential benefits will be fewer safety. Okay. So safety will be okay. See, once the machine will take care, we can safety established. Health problems, no health problems. Reliability, machine will take care. Higher throughput costing, lower cost. Robot will take care, computer will take care. No health asset, no safety protocols, because machine will take care. No labor involved. No safety protocol to be established. There is health problem for the labor. Robots will do the work. Where is the point of health workers? We can increase reliability on the robots. Automation is a rule. That's how the machine learning is there, data science, data analytics, data governance going on. That's it. So everything going to be computer-aided design. Using the software. Architects are nowadays using software only. Engineers using software only. They can design the products using the software. Buildings can be designed using the software. Computer-aided design. Computer will aid the design. I have a creativity. Computer helping me. That's it. So building construction, bridges construction, car manufacturing, cloth manufacturing, everything will be used by the CAD, computer-aided design, CAD. That's it. Either 2D model or 3D model. We can allow the user to view the object in different angles using CAD. Computer design will show the real, just give simulation also. Real, this is the product will be coming out. It can show the things. So computer can analyze how the product will be coming out. Different angles I can see the project. Top, bottom, up, down. All the 360 degree I can see the products using CAD. May also be used to conduct a computer test. So whether the engineered design parts are they going to fit together or not fit together, we can use it by CAD model. Now, the computer integrated manufacturing is going on. Everything is computerized to manufacturing system. Using design part, anything designed to be product, any product to be designed, we need integrated manufacturing, computer oriented. Scheduling, computer will take care. See, your manufacturing and computers are integrated. Manufacturing going to be functional, you need systems, you need computers. So computer and manufacturing are integrated. All machines are controlled by computers nowadays. That's integration. Scheduling, optimizing production, ERP integration. Other systems, monitors, everything has been integrated for performance. Machine in the assembly process, it is going to come into other machines using information, requirement, machine center specification, production short tolerance, everything will be integrated to computer and manufacturing, they are integrated. So flexible manufacturing system. Here the manufacturing system allows the products to be customized. Any customer requires customized products, we can do it. Not all products are going through this process. Customize a product, job order, that's called job costing. Job costing means the particular customer requires the job. Take the job according to specification, customization, customize the product requirement, please do the job and out him. That's it. Highly related computer integrated manufacturing. Allow the manufacturer to adapt to whenever the demand changes, the manufacturer will change. Customer requirement changes, manufacturing method will change. So whenever new opportunity available for the product, take the order. New order, customized nature, no problem. Okay, volume is higher, take the order and do the work. The flexible manufacturing system also there. I'm not rigid. I can do A, I can do B also. I can do C also if there is a requirement. I can give different types of output according to requirement. That's it. Flexible manufacturing system. That's it. So that is also computer integrated manufacturing. We can give flexible manufacturing system also. That's it. Customized nature, job order based. That's it. Next, variable or direct costing. Variable costing is nothing but direct material, direct labor, direct expenses. So generally they are called variable. Generally they are variable. Similarly, variable overheads, variable factory overheads, variable office overheads, variable selling and distribution overheads. They are all variable cost. So variable cost per unit is always going to be constant. So decision making process, variable cost is very, very important. When the company can able to handle variable cost, the company can sustain. Company can able to sustain. Variable cost per unit is always constant. They do not change with the volume. Fixed costs, they do not change with the volume, but variable cost per unit is always constant. So total fixed cost is constant. Variable cost per unit constant. Variable cost per unit constant. So total fixed cost constant. Total fixed cost never changes with respect of volume. That's it. But fixed cost per unit changes. Fixed cost per unit, it changes. Variable cost per unit constant. Total fixed cost constant. What is fixed factor overhead? It is applied more closely related to capacity to produce it. How many is going to produce it? Fixed factor overheads. Fixed factor, whether you're going to produce it or not, fixed factor overheads are going to be happening. The fixed cost, irrespective of production, fixed cost remains same as well. Example, factory rent. Factory rupees is supervisor salary. So they're going to be happening always. They are fixed always. Related to the capacity, going to produce over a period of time. they should report as a periodical cost. Fixed overheads cost are reported as a periodical cost. That's it. And let's see joint product and byproduct costing. See, generally, what is joint product? See, for example, petroleum industries and for example, milk products, milk production industry. So they are using joint products and byproducts. See, for example, to understand the layman language, generally milk will be procured and will be putting into process. So certain stage milk will be pasteurized and the heating and other process of chemical process will be going on. So certain stage, then it will be categorized into further process. The point it will be categorized. The milk will be converted into cheese, paneer, flavor milk, just like this. Buttermilk, guava, going on. So milk will be categorized to further points. So certain point from A to B, milk will be heated and chemical process going on, pasteurization going on. Up to this A to B is called joint cost. Joint cost. From the point B, it is called split off. The point is called split off. Split off. After split off, the products coming out is going to be cheese, paneer, flavor milk, buttermilk, and other things will be coming out. So after separation from the point B, cheese is emerging out. Paneer is emerging out. Flavor milk emerging out. So maybe kova is emerging out. Some alwa is coming out. That's it. So the point is called split off. It is called further cost. Further cost. After separation cost, we used to call this called after separation cost. From point B to cheese, after separation cost. From point B to paneer, after separation cost. This is called pre-separation cost. Pre-separation cost. From point B to cheese, paneer, flavor milk, kova is called after separation cost. ASC. After separation cost. The joint cost to be apportioned between these products in certain ratio. After that, after separation cost, we have to add to make the product cost for the cheese plus profit is sale of the cheese. Paneer. Suppose any cost of how to find cheese cost, nothing but joint cost apportionment. Joint cost apportionment. Joint cost has been apportioned plus after separation cost is equal to total cost of cheese product. Up to this joint cost. The joint cost to be apportioned between cheese, paneer, flavor milk, kova in certain ratio. Once the joint cost is separated, joint cost is a proportion between these two products. Then after separation cost of cheese to be added, and after separation cost of paneer to be added, and after separation cost of flavor milk to be added, and after separation cost of kova to be added to find the cost. Then profit is equal to sale of the individual products, cheese, paneer, flavor milk. So that's the idea. Up to certain point, the milk will be heated. It is going for some process. The point is called split off. After split off, it is going to be separated to make way for cheese, to make way for paneer, to make way for flavor milk, to make way for guava. What are the cost involved? After separation cost. The joint cost apportionment plus after separation cost is equal to cheese cost plus profit, cheese sales. So joint cost apportionment cost plus after separation cost is equal to paneer cost plus profit sale. Just like this. But that's the idea of joint and byproducts, right? Joint cost available. There are two or more products whose aggregate resale value is more than nominal. And the products are simultaneously same processing operation. Example, up to this same process. The joint processing cost must be allocated to joint product using some estimations. Different methods available how the joint cost to be apportioned. The allocations are typically based on relative sales value or relative measures. Our units are pounds. Next one is called byproducts. A product of a process having relatively small aggregate resale value in relation to sales value or main and joint products. Sometimes what happens now, small aggregate resale value coming out of the joint product. That's called byproduct. And byproduct, how the valuation to be done? For example, the sugar to be produced out of sugar cane. Sugar is the main product. Sometimes the scratches will coming out. The skull will be used for molasses, the byproduct. The sugar is the main product. The scratch or a residue out of the sugar cane, will be sold for molasses, sold for molasses production, especially in alcohol industry. Automatically it is going to generate some revenue. Any scrap out of sugar production will be sold as a molasses. It is going to generate some revenue. If any value could be recovered, yes, that is other income. sometimes the main product cost, from the main product cost, that byproduct, no, that residue, scrap, if it is sold, the recovery value will be subtracted from the joint cost, from the product, main product cost. For example, sugar cost we know, sugar cane to sugar cost we know, then the sugar cost, that scrap, no, scrap recovery value to be subtracted. Scrap recovery value to be subtracted. The scrap of the sugarcane production, sugarcane to sugarcane production, sugar production, the scrap will be sold as a scrap for molasses preparation. For molasses can be used for alcohol industry. Our scrap is going to produce some revenue. Our sugar cost, scrap recovery value to be subtracted. Model 2, method 2. Or the scrap value will be treated as a other income. Method 2, a scrap value will be reduced from the sugar cost. That's it. So sugar cost will ultimately reduce it. So any recovery value of byproduct, there are methods available. It can be treated as other income, or it can be subtracted from sugar cost, the recovery value of the scrap. Any byproducts coming out of the main product. Or sometimes it is transferred to other departments also. So the other departments also, they're going to process it, correct? No. So for other department production cost, then you can reduce it. So it can be given to other department. Of other department cost, this byproduct recovery value will be reduced. But there are three ways the byproduct recovery value will be adjusted. Either it can be treated as a other income, or for the main product, it is going to be reduced. The recovery value of the byproduct will be recovered. Scrap of byproduct will be reduced. Recovery value reduced from the sugar cost or the main product cost. Number three, sometimes the scrap will be transferred to other department. The other department, they sold the things. Of other department cost, the recovery value can be adjusted. That's it. So these are the options available. Any one of the method you can use. Anyway, the total joint cost reduced by NRV value. And byproduct is going to be inventory before joint cost to the main product. Right. That's a major thing. So for any joint cost reduced by NRV or the byproduct, any byproduct sold before the split off point, the joint cost then the recovery value to be adjusted. Thereafter only joint cost to be assigned to the main product. That's it. Our total joint cost reduced by NRV of the byproduct. What is NRV? Recovery value. Any byproducts coming out of the main product. So the byproduct to be sold, money to be recovered, it is called NRV. Our total joint cost minus recovery value of the byproduct to be subtracted before they are going to be allocated for joint cost for the main product. So before split off point, any recovery of the byproduct to be adjusted from the total joint cost before they are going for split off. That's it. Before they go for split off. That's it. So before split off, any byproduct to be sold, the recovery value to be subtracted from the total joint cost. So the balance only will be transferred to the byproduct. The balance only transferred to the main product. That's it. So what is joint cost? Cost incurred jointly in the process operation to bring the products to the split off point. I told you this is a split off point up to this. Milk to split off point. From the split off point to it is going for cheese production, going for paneer production, flavored milk production, coa production. That's it. So it's called joint cost. Of a joint cost to be involved or incurred till the products going for split off. That's it. After split off, any cost involved, it is called after separation cost, or additional cost. After separation cost or additional cost. Okay. After split off, any cost incurred is separable cost. After split off, joint cost. After split off, after separation cost. After separation cost. After separation cost. After separation cost. The joint cost to be apportioned plus after separation cost is equal to total cost. Profit is sale. So any recovery for the byproduct is happening before split off point, and the total joint cost minus recovery of this byproduct to be subtracted, then the balance cost to be apportioned between the cheese, paneer, flavored milk, and coa. That's it. That's the idea here. Let's see what are the methods available to joint cost allocation. There are different methods available. Okay, number one, relative sales value at split off. So there are 4 traditional methods available for allocation joint cost till split off. Till split off, it is called joint cost. Or the joint cost to be apportioned between the products. Okay, so 4 traditional methods available. Number one, relative sales value at split off point. So the joint product cost is allocated based on each product's percentage of total sales. at the split off point of all the main products. Suppose in case of split off point itself, there is any sale is going to be taken place at each product, that percentage, that ratio, sales ratio, the joint cost can be allocated. Suppose joint product cost can be allocated based on each product percentage of total sales value at the split off. Suppose split off, there are 4 products coming out of the main product. These 4 products are split off. What is the percentage of sales? 20% A product, B product, C product, 3 product, D product, 4 products. What percentage of sales is happening? So based on the percentage of sales value, the joint product cost can be allocated. Number 2, physical quantity. The joint product cost is allocated to each product percentage of production. How many physical units from the main products they're coming out? From A to B. Okay, this is called joint cost. This is called split off point. From B, there are 4 different products are coming out. So that's called product P1, product P2, product P3, product P4. What is physical units of all the main products? So these are the main products. Okay, these are split off points, main products. This is 20 units, 30 units, 40 units, 50 units. Suppose the joint cost, for example, $10,000. $10,000. The joint cost to apportion the ratio of 20:30:40:50 ratio. Joint cost to be taken. So joint cost to be taken, $10,000 to be split off into 20:30:40:50 ratio. That's it. This is called relatively physical quantity method. The joint cost can be allocated. That's it. Suppose, for example, so this Gyro company produces 15,000 units of product A, 10,000 units of product B, joint production process. So total cost 150,000. Suppose the product A, if it is sold in this split off point, $180,000, it can be sold. It can be sold in the production split off point, $90,000. But total joint cost 150,000. Sales at split off price 180,000, 90,000. How many is you produced? 15,000 A, 10,000 B. So what are the different methods available for the joint cost allocation? 150,000, right? 150,000. So so joint cost. The product is coming out to A and B. Right? Okay. So from here, that's a source. Here it is called split off. And the split off, the products are coming out, it's called A and B. Unit wise, if we divide, A units are going to be 10,000, 15,000, 10,000. 15,000 units and 10,000 units. Value wise, $183,000, $90,000 value wise. The NRV value, 180,000, 90,000. 180,000, 90,000. 180,000, 90,000. Value wise. The joint cost amount is going to be $150,000. The joint cost amount from source to split off is called joint cost. Joint cost amount is $150,000. How to be split off? So based on the NRV values, 180 plus 90, the total, the 270,000. That's it. The joint cost for A, $150,000 joint cost into 180,000 by 270,000. 180,000 by 270,000. Joint cost apportion between 80-19 ratio, 2:1 ratio. 18,000, 180,000, 90,000, 2:1 ratio. 2:1 ratio. 2:1. 180,000 by 270,000. That's it. 20,000. It's going to be 100,000. 2:1 ratio. This is 2. This is 1. 2:1. So into 2 by 3. Into 2 by 3 also can do. But similarly, joint cost for B, 150,000 balance it into 90,000 by 270,000 or 1 by 3 or 1 by 3. 1 by 3. So it is going to be 50,000. 100,000 and 50,000. Joint cost has been apportioned. 100,000, 50,000. Is this NRV basis? The same question, unit basis, 15,000, 10,000. Unit basis, 15,000, 10,000. Same question, 15,000, 10,000. Here, joint cost for A, unit wise. So totally 10,000, 15,000 units, 10,000 units produced. So totally 25,000 units produced. Ratio 15,000, 10,000. Again, it's going to be 3:2, 3:2 ratio. 15,000, 3 5s are 10,000, 2 5s are 3:2 ratio, 3:2 ratio. The joint cost for A is equal to 150,000 into 15,000 by 25,000. 15,000 by 25,000 allotted. 15,000 by 25,000. It is going to be. Please check it out. So 150,000 into 3 by 5 into 3 by 5, that is equal to 90,000. Unit basis is 90,000 rupees. The joint cost for the allotted. So joint cost for B is equivalent to $150,000 into 10,000 by 25,000. 10,000 by 25,000. That is equal to 60,000. Right. Anyway, 90/60 allocated. Unit wise joint cost apportioned. NRV basis joint cost apportioned. Suppose same products A and B sold at split off point at NRV basis apportioned. Same products is sold at a split off point 15,000 is 10,000 unit wise. But joint cost apportioned unit wise, joint cost apportioned NRV price. Same product A, product B. Number of units sold at NRV 15,000, 10,000. Number of value of the product sold NRV at split off point 180,000, 90,000. The split off point if it is sold 180,000, 90,000. Split off point if it is sold 15,000, 10,000 units. Unit based apportionment, NRV based apportionment. That's it. What is NRV? Net realizable value. NRV, net realizable value. Suppose if it is sold in the market, after all salesman expenses, what is the amount we recovered? It is called net realizable value. Recovery value, if it is sold in the market, is called net realizable value. That's it. Net realizable value. Net realizable value. That's called NRV. NRV, net realizable value. So the variation of relative sales value method. So generally, joint products at the completion of joint process, it is called split off. Suppose if sales value at split off if not determinable, then ultimate sales values are reduced dollar for dollar by additional processing cost after split off to arrive to relative sales value at split off. See, for example, a split off when you're not able to know exactly what is the value, the reverse method you can apply. For example, the source to split off, there is a joint cost. From here, 3 products are coming out, A, B, C. Here the sale price is given. After separation cost is given. Sale price of A is given. Sale price of B is given. Sale price of C is given. After separation cost and joint cost is given. Okay, right. Suppose imagine A sale price $100. After separation cost 20. Now split off the cost 100 minus 20. Split off the cost A split off cost. Split off we can have sales prices. Split off we have value. We have NRV at split off. Reverse method. 100 minus 20, it is going to be 80. Similarly, B. Suppose 120. After separation cost 30. Imagine 30. For B, 100 minus 30, 120 minus 30. 120 minus 30, 120 minus 30. It is called reverse method. 120 minus 30, it is going to be 90. C. Suppose here is going to be 150. After separation cost is going to be 30. Of 150 minus 30, 150 is the selling price of C product. Separation cost added, profit added, selling price. 150 minus 30, it is going to be 120. Right. Now 80, 90, 120s are values at the split off. So at split off, the values of A, B, C by using reverse method. Split off the values of A, B, C. A in my example 80, B in my example 90, C in my example 120. Reverse method. I know n value. I know after separation cost, but I don't know split off cost, split off value. But you can use reverse method. 80, 90, 120. So split off NRV by using reverse method 80, 90, 120. Our joint cost will be apportioned on the basis of 80, 90, 120 by using reverse method. That's okay. So joint cost you apportion the reverse method. I know after separation cost for each product. I know selling price of each output. But after separation, how the joint cost you apportion? I have a doubt. No exact value available at joint cost. How to separate? Now nothing available. Upon reverse method. So product selling price minus product separation cost is equal to NRV. Product selling price, product separation cost, NRV. Product selling price minus after separation cost, NRV. That NRV value there, the joint cash can be apportioned. That's the idea. Reverse method you can use it. That's what they're telling the example here. That's it. Product can be sold on. Yes, product can be sold. That's it. Same idea here. There are two products coming out. A and B. Product A value $60,000. Product B value $40,000. After separation cost, $15,000. $10,000. This is split off. This is source. At split off value 60 minus 15. A value 60,000 minus 15,000. 60,000 minus 15,000. That is equivalent to 45,000. B value 40,000 minus 10,000. 40,000 minus 10,000. 10,000. That is equal to 30,000. That's it. Now at split off NRV for A and B by using reverse method. For A 45,000. For B 30,000. For B 30,000. B 30,000. 40 with 30. 3:2 ratio. Suppose the joint cost 45,000. To be allocated between A and B, the ratio 3/5, 2/5. It can be allocated between the A and B the ratio. This is A value, this is B value. 40,000 3/5, A value, joint cost. 40,000 into 2/5, B value. That's it. So 40,000 into 3/5, A value. 40,000 2/5, B value. Joint cost apportioned by reverse method. That's it. So 27,000. Reverse method. I told you reverse method. 27,000. Here 18,000. So 45,000 into 3/5. Please check it out. Okay. Similarly, 45,000 into 2/5. So 27,000 joint cost apportioned between A. So 18,000 joint cost apportioned between B.
Subscribe to our YouTube channel Stride Edutech and press the bell icon to see new videos.